All right, what's up, guys? So today I want to go over a strategy known as selling cash secured puts. Okay, this is a really good strategy, I feel, for passive income. If you don't want to have to day trade or really look too much exactly at what you don't want to check charts every day, but you have a bullish position. You really like a stock. A lot of people like Tesla, so I have Tesla pulled up right here. Okay. So if you wanted to buy 100 shares of Tesla today, you can. It's as simple as this. Go to trade, buy market, boom, hit 100 shares, and you can instantly own 100 shares of Tesla at a price at the current price that it's at right now. Okay. But what I wanted to do was I wanted to show you guys a strategy that you can use to buy 100 shares and get paid instantly um, to do so. All right. It's called selling cash secured puts. So what you would do is you'd go to your trade tab, you go to the option chain, okay? And for your layout, what you're going to want to do is you're going to want to look up implied volatility. You're going to want to look up extrinsic, intrinsic, and the probability of touching. Hit add items and then hit OK. All right. These are the things that I look at when selling a put or selling a call. But for today's purpose, we're selling calls. Okay. So right now, we have that pulled up. We'll go ahead and we'll take a look back at the stock chart. So I have a just a simple support level drawn up right here at 744.63. That's basically 745, we'll call it. So if I think that that's support, what that basically means is I think that that's a good buy area. I think that there is demand related to the supply of shares at this current price at that price level. Okay, so if you wanted to buy 100 shares for a long-term investment, what you can do is you would go to your trade tab. Okay, you would go to the 740 strike price. All right, and we have the October 8th expirations pulled up. You would right click, you would hit sell single. Okay, and it will pull this up. It automatically changes it to 10. That would be for each contract is for 100 shares. So 10 contracts would be for 1,000 shares. We're only looking at purchasing 100. We're going to hit sell and you want to drag this up. Okay. The reason you drag this up is because we're selling. We want to get paid the max value of this option contract. Versus when you buy a contract, you tend to want to drag it this way and pay the smallest price you can. Okay. Then you would hit confirm and send, and boom. You would instantly, okay, get deposited into your account $1,835. How is it that? Well, it's 1835 times 100 shares. That's $1,835. So you could get nearly $2,000 because you want to purchase Tesla at 745. Okay. Now, if Tesla is above 745, if it's at 746, 750 at the date of October 8th, and this contract expires, you get to keep all $1,835 and nothing happens. You did not buy 100 shares because it did not go below your strike price. So therefore it was not triggered or exercised. So you just got to keep that money and it went straight to your pocket. You could have used it to buy 10 shares of AMD, for instance. Okay. Now, if let's say the price goes below 745, okay, then what happens is your call option or your put option is executed, okay, and you now are forced to buy 100 shares of Tesla at 745. Okay. A big mistake that a lot of people make when doing this is they choose a strike price. Okay, 745 is our strike. They choose a strike price that they are not comfortable owning 100 shares with. Okay, you can obviously get paid a lot more for 775. Okay, we can go here and hit sell single. Okay, and we can get $2,595 for every 100 shares we want to buy. But what are we going to do if Tesla drops all the way down to 745? Well, we're forced to buy 100 shares at 775 if it expires below that on October 8th. So are you going to be comfortable owning 100 shares of Tesla at 775 and the price is trading below it at 745? You have to ask yourself that. Okay, so there's two ways to go about it. There's two main strategies when choosing your strike price that you want to sell a cash secured put against. There is a passive, or there's a conservative, and there's an aggressive. Okay, so an example of a conservative, you would go to your probability of touching, and this means that this is basically the probability that the stock price is going to touch this price by October 8th. So if it has a low probability of touching that, it has an even lower probability of expiring below this price or at this price or below it. So what I like to do is I like to, when playing conservative, always go 20 to 30%. So we can look at any of these options right here. These all fall below 20 and 30%, and you can get paid 450 bucks or, whatever you want. This is something that I would do. I would be very happy if I bought 100 shares of Tesla 8 days from now at 620 and it's currently trading in the 770s. I would be like, man, I did great. I freaking bought the dip like crazy on that one. That's going to be a good long-term hold right there. But you might not feel the same way. Like I said, if you buy it at 775 and let's say for some reason it's all the way at 675, you force yourself to buy it $100 over the price. So you need to be comfortable with whatever strike price you choose, owning the shares at 100%. Okay. So that's an example of conservative, about 20 to 30%. If you end up buying shares here, then hey, you know what? You bought a pretty massive dip that only had really about a 20 to 30% chance of happening. So that's pretty good in my opinion. Okay. Now, more aggressive, okay, would be selling something between like maybe 60 and 75%, I would say. Okay. So something aggressive, this would be like this. So this is more aggressive. You obviously will get paid more because of this aggressive position. But there's a 70% chance that Tesla is going to touch 77.45 according to the option chain data on Thinkorswim. So with that being said, I have almost 3/4 of a chance of being able to grab Tesla at 745. Do I like Tesla at 745 for a long-term position? Am I comfortable owning 100 shares if it trades below 745? Well, if I am, then hey, why not try to buy it at 745 and also get paid $1,800 for it? Okay, so that's mainly it. I just wanted to go over that strategy. I really like this strategy a lot. I think it's really good for growing passive income. You can have yourselves a shares account and you can sell covered calls against the shares that you own, and just keep cash in your account. Never really have to buy or sell any stocks. And like I said, sell covered calls against the stocks that you own, and the stocks that you want to own, you can sell cash secured puts on them. So why not get paid for the stocks that you own, and why not get paid for the stocks that you want to own at a lower price? Thanks for watching. My name's Zach. And let me know what you guys want to see more of. I can make videos like these, tutorials. I can show you guys what stock I think is going to be the biggest runner or the biggest dropper in the next days. I can show you guys long-term positions. Give me some ideas. Let me know. Sound off in the comments below. Thank you.